This week, I'm talking tax year-end strategies and things to consider for next year. Stay tuned. One of the best ways to save money on taxes is to have a health savings account. That's also the long version for HSA. Now, especially during this time, if you're not retired and you have the option to enroll in your company benefits, there may be an option for you to do an HSA. Now, an HSA only qualifies if you're in a high deductible plan. However, it gives you a lot of flexibility to add money to this health savings account for the future. Now, you may not use it right away, but your money goes in tax deferred and comes out tax free if you use it for healthcare expenses. It offers what we call the triple tax advantage, right? So you get a deduction for it, which means it reduces your taxable income. It grows tax free, meaning it earns and generates return. You don't get taxed on that return as long as you pay for eligible medical expenses. Now, there are some limits for making contributions into the HSA, $3,600 for individuals and $7,200 for family. If you are 55 or older, you actually get another $1,000 catch-up contribution, and that's very important given what you can use the HSA account for. Now, aside from medical expenses, the HSA allows you to use the money for Medicare premiums, long-term care premiums in retirement. Also, it lets you pull down the income to use for certain medical products, medicines, different things that relate to not just doctor prescription, but over-the-counter medicine. So why doesn't everyone use the HSA? Because it's got so many great benefits. Well, the hardest one is that you have to have a high deductible health plan, meaning you have a very high deductible for your medical insurance. So if you're relatively young or don't visit the doctor frequently, it lowers your premiums to have a higher deductible, and it gives you the possibility to add money to this type of account. Now, if you let this thing grow over time, it can become a very valuable tool for you in retirement. So something to think about when you're going through your benefits this year. And last but not least, it is not an FSA. So if you get money into an HSA account, it's not a use it or lose it plan. The FSA, the flexible spending account, is. HSA is not. You get to hold on to that money. If you take it out for non-medical purposes, you do get penalized 20%. However, in most cases, you have a lot of flexibility to use it for medicals. Because we're coming to the close of 2022, there does create some opportunity for us as investment advisors to realize some capital loss. Now, why would we realize some capital loss, and what type of accounts would we realize those in? So, as we're going through our tax planning for the rest of 2022, one of the big things we look to is to see if you have an individual or what we call a brokerage account, could even be a trust account, something that is taxable if you do something, meaning if you sell a security or an investment, do you realize a gain? Do you realize a loss? Do you earn interest that is taxed or not? And so one of the biggest tools that we have is to be able to sell an investment and create a capital loss. Now, we can use some capital loss to offset some capital income, meaning maybe you sold another investment for a return or a gain this year. That would be very challenging given this type of environment. However, there are some cases where if you've held on to an investment long enough, you do have some large gain. And so we can offset some of that with some losses. So incrementally, we're going through client portfolios and accounts to make sure that the accounts are within balance, that they're allocated properly, how we have set them up to be. And if they're not, we can use this tool to realize some losses to offset some gain. Now, why would we want to realize some loss? You can also take $3,000 of long-term loss that goes directly against your income on your tax return. That's the maximum allowable loss you can take. If you have more than that, you can actually carry that loss forward. So even if we realize more losses for you this year than $3,000, we can use that to carry forward into future years to, again, keep bringing down your taxable income and maybe reallocate or re-strategize your portfolio to make sure that it's in line with what we have discussed with you. And the last one has to do with charitable contributions. So, what's another way you can bring down your taxable income and save money on taxes? Well, that's giving to charity. Now, because of some of the tax changes that have happened over the last couple of years, the standard deduction has gotten extremely high when we consider it against itemizing deductions. For example, in 2022, this is the current standard deduction as a married filing jointly or as a single. And so in order for you to get above the standard deduction, you have to have a lot of mortgage interest, or in this case, if you do a lot of charitable giving, every dollar above $26,000 virtually, if you're married filing jointly, allows you pretty much a like for dollar deduction against your income. Now, of course, there's a ton of reasons to give your money away and to support charities. But one particular strategy that may make sense is that if you give every year, it would be to bulk give your contributions. Meaning, instead of spacing out your contributions over the months of the next year, maybe it makes sense for you to make one large contribution at the end of this year in December so that you get a larger deduction for this year. Now, this would take away your deduction for next year, but let's say next year, since you're not going to be giving next year or giving on a lesser scale, it's not going to matter. You'll just take the standard deduction. Now, again, I'm not saying that you should do this just for the tax benefits, but the IRS obviously incentivizes the idea of giving, which, of course, we're coming into December. What better time to give than in December? So those are the 3 quick tax strategies that we're going through with you clients, or if we're not, we're doing them in the background anyways to ensure that if there's some opportunity there, we're taking them. So if you have some friends or family and they don't have an advisor and they're not thinking about any of this stuff because there's a lot of ways to save money on taxes, send them our way. We love to have a chat with them, explain to them some of these strategies that may work for them and may fit into their financial plan. I hope you have a great day and rest of your week. Until next time, take care.